Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good everyone, how are you going? Thanks for joining us on the podcast today as we navigate property stories, tales from the road from property investors right across the nation. And Zoom's been a great enabler for us to think about things differently. And I used to have a preference to get people into the studio to come and have a chat because I always found that it was a lot more conducive to a better conversation. And like everyone with COVID-19, we've been forced to pivot and change how we've done things, only for the betterment. Our stories now aren't just Sydney-centric or New South Wales-centric. We have people right across the nation now joining us on the Smart Property Investment Show, talking us through their investment journey. It's opened up the world. There's no borders anymore in property investment. We're absolutely diversified. So irrespective of where you are in Australia and you want to come have a chat with us, make sure you get in touch with the team. Editor at smartpropertyinvestment.com.au. Come and have a chat. Tell us what's going on. Now, I'm hoping I should know, and it was in the brief sort of background I did before entering this podcast with our guests today. Hopefully, on the basis of what I just said, this investor's flung part of the world that I've never heard of, Australia, I've never heard of, and not just down the road in Sydney, Lloyd Edge. Whereabouts are you based, mate?
Well, Phil, I'm actually based in the Sutherland Shire in Sydney.
Oh, there we go. So far away. You need your passport to get down that way.
Absolutely. Well, I'm over the bridge, and once you get to the Shire, you never leave, right?
You never leave, right? Well, that's really helped my introduction here. I was hoping that you were from somewhere like Perth or at least Armidale or Port Hedland, even, or Darwin. But the Shire, I won't hold it against you. I'm normally quite negative on the Shire, but it's not a bad place to be buying property at the moment, is it?
It's pretty good, yeah. And I've bought a couple of properties down this way, so it's all good.
Very good. So thanks for joining us today, Lloyd. I really want to have a chat through your investment journey and what is hugely popular on a Smart Property Investment Show are these investors' stories. And, we try and get a lot of diversity where we can, and it's just a product of property investing in Australia. Most property investors only have between 1 and 2 properties. That's the big chunk of Aussie property investors. Very small numbers. Only like 20,000 Australians have 6 or more investment properties. And I think you probably fall into that latter bracket. So I like to tell the stories of those people with larger portfolios and a journey to get towards a large portfolio. And a lot of it is the why, but also the how, because often as people earmark property as a wealth creation tool or start their property investment journey, they like to emulate other people and learn from what's worked and what hasn't worked. So for you, you've got a $12 million portfolio, and I'm quite keen to understand how many properties are in that, because it's going to give me some sense of the strategy that you followed.
Yeah, Phil, so I've got about 18 properties across my portfolio at the moment. I'm obviously sort of bought and sold along the way, but currently holding that many properties across the portfolio.
Okay, nice. And let's have a chat about diversification. Where are they? If you can just sort of start with, we'll start top end and we'll drill down into some of the specifics about each property. How many different states you've got property assets in?
So I've got them in 3 states. So just on the eastern seaboard is where I'm investing. So we've got New South Wales, we've got Victoria, we've got Queensland, both in the capital cities and then in some of the strong regional markets, obviously using different strategies in those different markets, which we'll delve into as well. Okay,
brilliant. And how long have you been investing for?
I've been investing for about 18 years now.
Okay. So you've been at it for a little while?
Yes, absolutely. And, when I first started, I wasn't even dreaming of becoming a property investor with a lot of properties or anything like that. And I didn't really have a strategy at first. So it's kind of evolved a bit over the years and everything like that.
Let's have a chat about when you started, so 18 years ago. So call it 2000. And what were you doing back in 2002 to start investing in property, and what was the reason for it?
Yeah, so I was actually a teacher. And back then, so I was a music teacher, but I was a peripatetic music teacher, which basically means I wasn't employed full time. I was basically just working in schools, getting paid by the hour. The problem for me is I wasn't earning any superannuation at all, and I couldn't really see myself having much financial security in the future. So that was really the catalyst to try to start investing, because I thought I'm not going to have any super, I don't want to live on the pension. That wouldn't be the lifestyle I wanted. So I started to build up our portfolio towards creating some security. But at first, I didn't really have a strategy, and I was really just sort of buying sort of a few properties willy-nilly, which, most of those did quite well, simply because I was probably a little bit lucky and things like that. But it was later on when I started to really develop a strategy and understand why I was investing that helped me to actually get, a lot more gains, a lot more returns out of my properties.
So you mentioned a word which I'm not familiar with when you said you're a something music teacher. So I know what a music teacher is, because the only time in the history of my schooling that I got 0 on a report card was for music. So I'm very familiar with music teaching in that regard. And let's just say I wasn't, as you can tell, a great student, but you said you're a something music teacher, wasn't full time.
Yeah, peripatetic. What that actually means is that what I was doing then was going into a school and teaching the kids basically how to play instruments.
Okay.
And I was getting paid effectively by their parents. So I wasn't employed by the school.
Oh, okay. So you're self-employed essentially.
Exactly. I was self-employed. I was a sole trader. So I was classic sole trader like many other businesses out there that are sole traders.
And you weren't paying yourself into a superannuation fund at that point in time?
That's correct. And having had no real financial upbringing and not learning anything about that when I was at school, I didn't even think about paying myself any super at the time. So all I was thinking about was I was not going to have any money in the future. So I started to actually plan some investments for that.
Okay. Well, what sort of music did you teach?
I was a brass player. So I played the trombone.
Okay.
And the euphonium. You've probably never heard of that word before.
Was a new journey for me. Was the trombone a cool instrument that the kids wanted to play?
It was actually, yeah. Trombone's a pretty cool instrument. Yeah, okay. Trombones and trumpets are all pretty cool instruments. So, but fun teaching that. No, not a lot of money in it, but there's quite a bit of fun.
How old were you back then when you were doing that sort of stuff?
Well, I did that sort of through my 20s. I was also, playing as a musician. So I was doing sort of gigs and stuff and earning a bit of money that way as well. But, not an enlightening amount of money or anything like that.
So tell me about the moment where you went, okay, I've got to think about the future. Was it a specific catalyst, or was it a light bulb moment, or was there a trigger for it when you went, I've got to do something because otherwise I'm going to find myself in a spot of bother when I choose to retire or get older?
Yeah, look, I think it was just, I started to realise that, you just can't work like an hourly rate for money all the time. And I realised that it was actually after I bought my first property, and I was actually living in my first property, but it was then that I was actually had a sort of a mortgage, and I was still, being paid this, I was not employed full time, and then I was paying a mortgage and then, not getting paid at all during school holidays. That was one of the things about that. And then I thought I need to start having my money work for me. And I remember that being sort of a bit of a catalyst, probably back in about, 2005. And I only owned about one property then. I thought I need to do something. And I could see that my passion for teaching was not something that would last forever. I didn't want to be stuck doing that forever. And I wanted to have a change and create some lifestyle in the future.
And the first property then for you was a principal place of residence, and that was somewhere to live, so shelter. What was that? Where was that?
So that was a little one-bedroom apartment in Rockdale, just near the airport in Sydney. And it was a new apartment, not off the plan, just a newly built apartment, which I got a low doc loan for. So I managed to sort of find a broker at the time who could get me into a low doc loan and those sort of things that I didn't really know much about at the time. And I lived in that property for a couple of years. And then, that's when I really started to think that I need to do something. And that property was quite well located because it was near amenities and, near transport and near the water and everything like that, that I thought I could turn that into an investment property, move out into another property. And that's when I started to build up a portfolio. And I actually bought my second property, and I bought a second property and moved into it as well. So I was doing things that I actually would advise against these days, as I kept sort of buying properties and moving into them. So a lot of my first principal places of residences, PPORs, were actually homes at first that I turned into investment properties.
Investment properties.
That was some of the mistakes I was making at the start that I'd certainly tell people not to do these days. But, my second property was way out in Ingleburn, near Campbelltown, but I was working at a school in Bondi. So it's like a 3-hour drive up the M5. Lucky I had a motorbike, and I'd sort of, go up the middle of a lane or something like that. And
one of the most miserable drives in the world, the M5. And that's not to give a hard time to our good friends out in the southwest of Sydney, but the road, at least is getting a bit of help now. I think that they're putting dual carriage in, which is pretty good. So at that point in time when you went from your first principal place of residence, you turned out into investment property into another principal place of residence, what were you using as mechanisms for your education then? What were you reading? Who were you listening to? How were you shaping your strategy?
Yeah, so I was attending a few seminars, but I was doing a lot of reading and books that inspired me, such as Rich Dad, Poor Dad, Robert Kiyosaki, and a few of those other books that he'd written, like the Cash Flow Quadrant. Books like that weren't even necessarily specific to the Australian markets, but just sort of property in general that were quite inspiring because it was about sort of how to create cash flow and things like that. And I really started to change my mindset around the negative gearing thing, which we're all taught in Australia that, you should do, sort of lose money so you can get them in money back on tax and all that. That to me has never really made much sense. And I really started to believe that if you negative gear properties, you are going to be stuck in a job forever. So, and, reading some of those books and, seeing what some people were doing, I kind of thought I need to start creating some real wealth in properties and some positive cash flow so that I could actually turn property into assets that would actually work for me. So I didn't actually have to be a teacher forever.
Mm. And was that a strategy for you? You obviously enjoyed the music, but did you actually enjoy the teaching? You never thought this is my full-time career forever?
I didn't love it when I first started because I just didn't think I was very good at it. And then I kind of got better at it. And then I started to really love it. And then I think I was actually quite good at it. But then I actually started not to enjoy it and started to lose the passion. And that wasn't so much to do with the kids. I mean, kids are great to teach. It was more about some of the politics, in the system and the people you work with sometimes and things like that. And for me, I'd actually look at some of the people I was working with and other teachers and they'd say things like, I wish I'd, done something else 30 years ago. And I actually thought to myself, I don't want to be that person that, I'm 70 years old and I look back and think, I could have done something 30 years ago, but I wasn't game enough to. So I actually decided I wanted to actually make something happen so that I, didn't teach forever. And when the time was right, I'd be in a position that I could actually walk away from that and actually live the lifestyle that I wanted to create.
Lloyd, we're going to go to a quick break. When we come back, we're going to chat about property number 3 and what happened after that. Back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with property investor Lloyd Edge, chatting his journey to a portfolio which now is valued at circa $12 million and includes 18 different properties. He kicked off principal place of residence that turned into an investment property, Rockdale. Property number 2, which was a principal place of residence, was Ingleburn. And I know some people have done really well out in Ingleburn. Do you still hold that property, Lloyd?
I actually sold that, Phil, a few years later, and I probably sold it at the wrong time. I did make some money on it, but if I'd kept it for, another quite a few years,
you would have done really well.
I would have done it really well. Yes.
If you held that through that period, sort of 2005, 2006, even if you held it through that next sort of Sydney boom in the early 2012 and 13, you probably would have doubled it, I imagine.
Yeah, so I did actually sell it, I think, around about 2012.
Okay.
So I did make some money on it, but the market kept going. I mean, looking at it now, if I had held it to about 2016, I would have really made some money on it. So that, I guess, is one of the mistakes in hindsight. And of course, I sold that property, took that money and invested it elsewhere. But I probably should have just sort of, kept that property and leveraged off it or something like that.
And that goes to the point around strategy. And, with 18 properties and 12 million in valuation, you're a sophisticated investor. And, by that comes experience, a bit of scar tissue. You've been in the depths of despair, no doubt, and the heights of happiness. But you get to look at your journey with the benefits of hindsight now and talk about strategy and applying strategy and the tactics to get to that realization. Now, where you sit right now and look at your portfolio, what has your strategy been? Is it, touching on what you said beforehand, it sounds like it's cash flow positive. And is it buy and hold, or you don't mind a bit of selling along the way?
My strategies are generally buy and hold. So I've sold along the way because I may have been maxed out and I needed to sell just to free up some serviceability to move forward, in which case I might sell an underperforming property or something like that. Or sometimes there may be occasion that I may want to sort of, I develop a duplex and sell it because I just wanted to sort of make some money there, make it sort of a quick return that I can then put the profits onto my PPOR debt and that kind of stuff. But generally, the strategy is buy and hold. And the strategy within that, I've done a lot of developing small developments. So, nothing too extraordinary, but things like duplexes and triplexes,
okay.
Things that you can build, subdivide, and get a good equity gain that also are cash flow positive.
Nice. And let's have a chat about property number 3 after Ingleburn. What was next?
Well, that's a funny one. So I'm still a bit uneducated here and I'm wanting to, get ahead in property and create some cash flow. But of course, still not knowing, too much about all the fundamentals and everything, I went and bought a property in Blackwater, which is a mining town in central Queensland.
Ooh. Okay.
And this is a funny story. And I don't
know if it's going to be too funny.
Well, I can look back on it now. It's probably not that funny, but I actually put a chapter about it in the book that I recently wrote. But so I bought this property. It was about $260,000, but it was returning about $800 a week in rent. So it had, plenty of
mining town
income.
Yeah.
And of course, at the time, I was just thinking, this is really, really exciting. And at the time, because of the mining boom that the country was going through, it was getting about 23% growth year on year anyway. It was just growing and stuff. And, if I'd sold it at, sort of before the boom collapsed, then I would have done really well. But of course, having a buy and hold strategy, I'll just hold it. Of course, at the end of 2012, the mining industry, collapsed. And, values went down. So my property went from being worth what might have been something around, 600,000-700,000 at the time, down to being worth about 200,000. And of course, the rents plummeted as well. But that's a lesson learned, not to invest in an area that has only, one industry, and then the industry collapsed. So, I'm really big on investing in areas that have all the, have several pillars of growth and everything like that. So they're not just driven by, one industry that might fall over and everything. It's a big learning experience. I still got that property because selling it isn't really going to do me much good because it's probably worth less than what I bought it for. So it's gone from being highly positively geared to being a negatively geared property within my positively geared portfolio. So I kind of swallowed that up, and now maybe it's kind of good for tax in a way, but not really. But that's the kind of the story of that property.
Yeah, herein lies the dichotomy in investing in mining towns. And if you buy at the right time and you reap the benefits of increased capital growth, riding a wave of really good yields, I know some people have absolutely killed it in mining towns, but therein lies a challenge as well. Once that economic activity ceases, it goes back to just being a country town and typically in the middle of absolute nowhere. And I've just, for my own knowledge, I just Googled Blackwater and it's west. Well, I'm going to call it a couple of 100 kilometres from Rockhampton in Queensland. And I imagine there's not a lot out there. It's on the way out to Emerald. There's still some mining activity out that way, and Emerald's still a big mine, but it's gone from being, the build-up phase into production phase. And, if you can time it well, you do well in mining towns, as I mentioned, but that's just going to sit there now and swallow up cash flow and just be a bit of a hindrance in your portfolio. And this is an important point for a lot of property investors, is that don't mix up regional with mining town. Regional is very different to a mining town. A mining town might be a regional location, but a mining town typically is only driven by one economic area, and that is mining, and there's not much else there. Whereas regional, if you are investing in regional towns, and we chat a lot about this on the Smart Property Investment Show, typically you've got 3, 4, 5, 6 different economic drivers to support growth in those areas. And is that what you're seeing now? Has this burned you from investing outside of the capital cities, Lloyd, or are you still investing in regional areas?
No. So, look, I've got properties in a lot of regional areas and that have done really well. One of my better performing properties was actually in Armidale, which is where I think you're hoping I was from today, but I'm not from Armidale, but I've been there.
Like I channeled Armidale there somewhere. It's the psychic in me.
Yeah, I've got properties in Toowoomba, for example. Okay. But there's a strategy behind them. But these are areas that have, because I'm much more educated and sophisticated investor these days. So obviously buying in areas that have several industries, and like you said, 4, 5, or 6 pillars. So I like to sort of look for at least five industries in an area. And if they've got a university, a hospital, a major upgrade in their shopping centre, rising population and clear government spending, then they're the things I like to look for. I've done well in regional areas, but there's also a strategy behind that. So there needs to be something, because whenever you're investing in a regional area, the growth is going to be more limited than in a capital city. And I'm really big on actually adding value to a property. So if I'm going to invest in a property, then I'm going to have to develop it, or I'm going to buy something and subdivide it, or I'm going to buy something and renovate it. But I'm not just going to do a buy and hold strategy and just let it sit there, because the growth won't really be there like it would be in Sydney or Melbourne if you let the market boom. So there is a strategy behind everything I do. And I've done well with most of those other properties that I've bought in most areas that I've got, simply because I've had a strategy put in place, and I have learned from the lessons. And I laugh about Blackwater. Yes, it does swallow up cash flow now, but it's a lesson learned, and I think we all make mistakes, and I like to share that, share those mistakes with people.
Yeah, and my portfolio is similar to your portfolio, and everyone's got a Blackwater in their portfolio. I don't know many property investors that don't have something which they just, I don't say they keep it there as a reminder of how not to get it right, but often it's hard to extract yourself from these type of properties once you secure them. And for a lot of property investors, the key thing is that, and there's a good reason to my earlier point. There's a good reason why most Australians only have 1 or 2 properties, because typically the first or second property is the wrong property, and it stops them from investing for a long period of time. You don't want Blackwater to be your first property, because you're not going to get to property number 2.
That's exactly right, Phil. That's exactly what I always say to people, and I actually wrote about that, a chapter about that in my book, Positively Geared, because if you buy the first property wrong, then that can really stop you in your tracks. Buying the wrong property in the wrong location or having the wrong financial structure can completely stop you. I was lucky simply because I had a few properties under my belt that were actually performing well and they were doing okay. I just thought to myself, okay, I really want to start making more cash flow. And at the time, I was a bit greedy and I thought, this is really good cash flow on it and getting good growth, when really the strategy really should be longer term. Because I've got cash flow positive properties in Sydney now, but a lot of them I bought negatively cash flowed at first, but over the years they've become positive cash flow. So you just need to have that strategy and understand how that works. But if I bought a Blackwater first up, then I would have been stuck. And that's one of the things that I really like to get the message out there about, really people really understanding and getting educated to make sure they don't make a mistake first off in their portfolio, because that can really hurt them.
So I want to get into the whole concept of cash flow positive properties, and we'll do that in a moment, Lloyd, after the next break. But let's just round out the portfolio. So you mentioned Armidale, you mentioned Toowoomba, and maybe we can dig deeper into that at a point in time. I'm conscious of how long we have with each other today. What other locations are you in at the moment?
So look, I've got a few properties across Sydney,
yep.
And I'm in Melbourne and I'm in Brisbane, and I've got probably 2 or 3 properties there in Brisbane. I'm a handful of properties in Sydney. So look, I'm pretty well represented in the capital cities on the eastern seaboard. Some people say they want to invest in every state or they want to have a property in every capital city. I don't subscribe to that. I don't invest in Perth, for example, because I think it's too reliant on the resources sector. Same with Darwin. If you look at the statistics for the last 10 years, Perth and Darwin were the only property markets that actually went backwards in an average over the 10-year period. Everywhere else actually increased in value. So that says something about those markets. So I believe, for me, the value is created on the eastern side.
And to give me some sense also of your strategy, what suburbs are you in Sydney?
So in Sydney, for example, I've got properties on the northern beaches.
Okay.
I've got property in Alexandria, which is sort of a blue chip apartment right near the city. I've got properties down in the Shire. And I've still got the one at Rockdale. I've got our home, our PPOR is actually currently in the Shire.
Great. And Melbourne, whereabouts are you?
So in Melbourne, I've got a property in Footscray.
Yep. Okay.
Yep.
Very good. And in Brizzy, and was Brizzy the latter part of the investment journey? Is that where you've been buying most recently?
Probably not so much very recently, but probably towards the latter part. So I probably started in Brisbane in around about 2013, 2014. So I've got a couple of blue chips around there, like a townhouse in Morningside and an apartment in Newstead, and then something a little bit further out in the Acacia Ridge, which is a dual income property.
Yeah, nice one. Lloyd, we're going to go to another break. Back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Lloyd Edge, property investor. Now, Lloyd, you've spoken a couple of times about your strategy and this concept of cash flow positive properties. So the holy grail for all property investors is to buy a property going up in value really quickly, and it's positively geared, as in all the costs associated with holding that property is less than the money that it generates. Now, just to challenge the concept of positive cash flow, all properties over time should become positively geared and generate positive cash flow. And that over a period of time might be 100 years, right? Because it depends on the LVR you have connected into the property or how much to put into it or what sort of rent you're generating. A lot of people go out there and say the holy grail is cash flow positive, cash flow positive, cash flow positive. I don't know too many people who have actually secured from the absolute get-go cash flow positive properties unless they put in massive deposits. How does that work?
No, absolutely right. And the other thing that people don't understand is that cash flow itself isn't what creates the wealth. It's actually capital growth in properties. So some people are out there trying to buy just cash flow positive properties in regional centres, and they might buy 10 of them. But then if that doesn't get any growth over a 10-year period and it's worth the same as what they bought them for, then they're actually no better ahead, because the cash flow positive rent that's coming in is just simply paying off the weekly mortgage, but not actually the I guess they're not actually creating any wealth because they're not getting any capital growth. So essentially, in terms of buying cash flow positive properties straight up, my strategy for that is actually dual income properties. So that can be a duplex, could be a house with a granny flat on it. To be doing them in areas that are achieving growth as well, then you need to be in the right sort of area. So, for me, I can't just go out to Broken Hill and decide I'm going to buy a cheap duplex there and have really high rent on it and expect to get growth. So they've got to be well positioned. Now, as I mentioned earlier, in Sydney, I've got cash flow positive properties, most of those were negatively geared when I bought them, but over time they've become positively geared. So I haven't been a positive cash flow investor from day one. So I actually started with a negatively geared portfolio and then started to, become more geared over the time, and then change my strategy to help get myself that way. A couple of the most recent properties of the one I bought in Alexandria, which was just this year, was cash flow positive from day one because I put in a large deposit because I've got sort of the funds to do that and everything like that. Investors starting out, including myself when I started out, didn't have those sort of funds. So you build that up over time. So absolutely. And I think what's important to note is that to get wealth and become a successful investor, you do need that capital growth. You can't just chase cash flow positive properties and expect to actually become a successful investor just like that.
Yeah, absolutely, I agree. And my message to our listeners would be careful if you see properties marketed at the top end that this is a cash flow positive property. You really need to look under the hood, because cash flow is unique to every single individual depending on your own personal financial circumstances. And to Lloyd's point, buying a property in Alexandria can be cash flow positive from the get-go because he's put a significant deposit into it. So just be wary when you see that in marketing material that is cash flow positive, because you've got to see whether it's cash flow positive to you. And property investment is a game of cash flow, it's a game of finance. You need to make sure that you can hold your property for as long as possible, potentially and hopefully in a cash flow positive position, to realize the wealth effect through capital growth, because that's what you realize at the end of it, when you can sell your properties down or retire or do whatever else you want to do with it and sit on the beach and drink pina coladas. For you, Lloyd, and I can look at this in the basis of my portfolio, I have the same number of properties in my portfolio. My property portfolio is still some way off being positively geared, and a lot of that is a product of how I invest and the structure that I invest within. For example, I'm paying sort of $30,000+ a year just in land tax on properties in New South Wales, which if I bought them in my personal name, I wouldn't be paying. So again, it's a product. Cash flow is a product of, your financial circumstances. For me to change the profile of my portfolio to be positively geared, I can't really do much with the income earning side, but I can do a fair bit with the debt side. So renegotiating rents and all this sort of stuff. What would be your key tips other than that to help shape or change or acquire, develop a portfolio with a view to being cash flow positive? What do you need to get right?
Well, you really need to get understanding the structure right at first, and understanding if you're buying in a trust or a company structure versus your personal names, for example. So obviously, if you're buying your personal names, you get the negative gearing benefits, you lose them if you're buying in a trust and things. And obviously, you need to speak to your accountant about that. But you need to actually understand that and what's right to do. Get advice on which is right for which properties and all that kind of stuff. Also diversifying across different states, because you're going to have land tax. All states have land tax thresholds. So if you've got all your properties in one state, then you're going to get land tax much sooner than if you actually diversify across different states. So that's an important thing. And you really should get some advice and understand that before you even buy your first property. So you can sort of prepare yourself. So when I'm working with my clients, I like to prepare a roadmap and a strategy for them, so they've got an understanding of how they're going to get to where they want to get to right from the get-go. So it's not just buy a property and then decide later how you're going to buy the next property, but it's really getting that structure right. Where's the property going to be? How's that going to fit into your portfolio? How's that going to help you buy the next property? I can't enforce enough that education is paramount to getting into property. I wasn't educated when I first started. And I really want to get the message out there that you really do need to be educated. Get some advice from mentors or from people who have maybe done what you're trying to achieve, and really get educated before you move ahead with any such purchase.
So what's next for you, Lloyd, on your property investment journey? Is this it? Is 18 enough? Is $12 million at the moment enough for you to do what you want to do, or you're going to keep at it?
For me, it's, obviously achieved a lot of the goals and dreams I had. I mean, at the moment, I'm working a lot on growing my buyer's agency business that I've got. So that's something that I'm putting a lot of focus on to at the moment. I'm still investing in everything like that. But in terms of my business, I'm working on growing that to sort of to help more people, and also to work on some of the philanthropy kind of things that I want to do, in the future and stuff as well. So I've kind of got some other plans other than just buying more properties. And for me, it's never really been about a number. So it's not about, how many properties you have or what the value is. It's about the lifestyle that it helps you achieve. And, my wife and I bought our dream home a couple of years ago, which is, I guess, something that we wanted. And it's kind of a major milestone. So, obviously paying all that off, getting rid of that debt would be, priority and then, capitalizing on the portfolio I've got and, eventually sort of paying off everything. It's got about a 45% LVR at the moment. So 55% in equity, 45% in debt. So it's a pretty good equity position, but obviously ultimately all debt needs to be paid off. So for me, making sure that, everything's really comfortable and paid off so that, our family's in a really comfortable position. So I think that's really important. But I think for anybody listening, having I always sort of reinforce that job security, as we've seen lately, is not really something that can be relied on. So I think that if people can sort of look to invest and build up a portfolio over the long term that can actually pay them an income, then they've got a second source of income. Because if you can have income from more than one source, like from a portfolio as well as from your job, then you're sort of mitigating against the risks of maybe losing your job and all that kind of stuff in the future, as well as creating a lifestyle for yourself so you can at some stage retire from or cut down your hours from your work and things.
Yeah, that's a good point. And it's a good looking portfolio with the equity position in it, and in many regards, you're wealthy. And it's an interesting discussion I have a lot with property investors about their attitudes towards the concept of wealth. What does it mean to you? What's wealthy mean?
Wealthy to me it's not really about money. Wealthy, it's about lifestyle. It's about being able to do what you want with your family. And one example is, we had our son last year. I've got a 14-month-old. For me, I was able to go to all the doctor's appointments with my wife and support her the whole way because I didn't have to go to work. I didn't have a 9-to-5 job to go to, for example. That for me is wealth because I'm not tied down to anything 9-to-5. Having, being able to go out on the boat on the weekends and not having a boat I'm not saying that's wealth, but just having that sort of lifestyle is something that I think is nice to be able to do and just spend time with family and friends, and also, donate to people. So, for example, my business donated 20% of all funds received in January and February this year to the bushfire repeal. So that's an important thing that I like to do. So actually being able to give back and help people, I think is really important. I think that's what you need to do, create wealth, is you need to be able to give back and help others that are less fortunate or that are struggling. We don't all need massive bank balances just sitting there just for the sake of it. So we need to be able to proactively do that. And if you look at the most wealthy people in the world, they all donate or they pledge their fortunes to greater causes than themselves.
Well said. And I think a lot of people have realised through COVID-19 that all the stuff that they used to think used to make them happy or were symbolic of wealth are largely not needed. So it's been a really good reset for everyone. Thanks for your time, Lloyd, today. I've really enjoyed the chat. Make sure you stay in touch. Let us know what the next purchase looks like, and all the best with your new venture.
Thanks, Phil. Good to be with you.
Nice one. Remember to check out smartpropertyinvestment.com.au. If you're a social media person, Smart Property HQ, you can follow us there, whether it's Facebook, Twitter, LinkedIn, or Instagram. Please get the reviews coming on this podcast. We've been getting heaps lately, and I know Lloyd's going to do one straight away after listening to this. Say, what a great podcast, no doubt. But wherever you listen to us, whether it's on Android or on the Apple platform, the team here get a real kick out of it. It's just not me behind the microphone. It's a great team of really talented broadcast professionals there who make me sound good. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Propertyology regards right now as a very exciting time for investing in Australian real estate. There are some fantastic opportunities that Propertyology can help you take advantage of before buyers re-emerge from their coronavirus cocoons. Propertyology has a national focus. Now more than ever, experience and knowledge are the most valuable currency. Propertyology has that in spades. To find out how Propertyology's multi-award-winning buyers agents can help you prosper, contact them now at propertyology.com.au.